From 2019 to 2025, the Aptera solar electric vehicle was everywhere in crowdfunding campaigns. Designed to solve range anxiety and charging infrastructure problems, it raised over $140 million from excited investors. Yet behind the revolutionary promises lay fundamental manufacturing challenges. Critics called it a pipe dream. Investors loved the cutting-edge technology. These are the shocking secrets of Aptera Motors' investment opportunity. The story begins in 2019, when Chris Anthony and Steve Fambro restarted Aptera Motors after their original company failed in 2011. This time, they promised something different. A three-wheeled solar electric vehicle that could travel 400 miles on a single charge, with solar panels providing up to 40 miles of free daily driving. The concept captured imaginations and wallets alike. Sandy Munro, the legendary automotive analyst who tore down Tesla vehicles, invested $4 million and declared Aptera was creating a new industry. By 2024, over 38,000 people had reserved vehicles, representing $1.4 billion in potential revenue. The most obvious example of Aptera's fundamental problem was their production timeline. In 2021, they promised deliveries would begin in 2022. Ask almost any reservation holder what frustrated them most, and they'll tell you about the endless delays. By 2023, deliveries were pushed to 2024, then 2025. Now, as we sit in October 2025, production has been pushed again to 2026, with full-scale manufacturing not expected until 2028. What it lacked was manufacturing experience. The company had brilliant engineers and innovative designs, but automotive manufacturing is brutally complex. In reality, Aptera's leadership team had never successfully scaled vehicle production. They underestimated everything: tooling costs, supply chain complexity, regulatory hurdles, and quality control challenges. The unexpected consequence: investor confidence began cracking. Reddit forums filled with concerned shareholders questioning whether their money would ever turn into actual vehicles. Even their biggest supporters started asking uncomfortable questions about whether Aptera would join the graveyard of failed EV startups. Behind Aptera's sunny marketing campaigns lay a darker financial reality. The company had burned through approximately $190 million by 2025, yet had delivered exactly 0 production vehicles to customers. Their latest SEC filings revealed they ended 2024 with just $13 million in cash and equivalents, a dangerously low runway for any automotive startup. What it lacked was sustainable revenue. Unlike established automakers with existing product lines, Aptera had no income stream while developing their vehicle. In reality, they were entirely dependent on continuous fundraising to survive. Each delay meant burning more cash without generating sales. The most obvious example was their $60 million convertible note offering launched in July 2024. This wasn't expansion capital, it was survival money. The business reason for the decision was simple. Without new investment, Aptera would run out of operating funds within months. The unexpected consequence devastated early investors. Each new funding round typically came at lower valuations or with conversion terms that diluted existing shareholders. Those who invested in 2021 at higher share prices watched their paper wealth evaporate as the company repeatedly returned to the capital markets with increasingly desperate terms. While Aptera struggled with production, the broader EV market exploded around them. Tesla's dominance solidified with 49% of U.S. EV sales in 2024. Rivian went public, achieved profitability, and began scaling production. Chinese manufacturers like BYD became global powerhouses. Traditional automakers launched competitive electric models. What it lacked was market timing. The company missed the optimal window when investors and consumers were most excited about revolutionary EV concepts. In reality, by 2025, the market demanded proven execution over ambitious promises. Customers wanted vehicles they could actually buy and drive. The business reason for concern was obvious. Each month of delay allowed competitors to strengthen their positions. Ford's F-150 Lightning, Rivian's R1T, and Tesla's Cybertruck captured the attention and wallets that might have gone to Aptera's futuristic design. The unexpected consequence created a catch-22. To differentiate from established competitors, Aptera needed their solar technology and ultra-efficient design to work perfectly. But perfecting these innovations required more time and money, which they increasingly lacked. Every engineering challenge became an existential threat. Aptera's three-wheeled design created a classification nightmare with automotive regulators. The vehicle fell into a gray area between motorcycles and cars, creating unique safety and certification challenges that traditional four-wheeled vehicles don't face. What it lacked was regulatory clarity. Federal and state agencies had limited experience with vehicles like Aptera's design. In reality, each jurisdiction potentially required separate approvals, creating a complex web of regulatory hurdles that consumed time and resources. The most obvious example occurred in 2024 when design changes forced Aptera to abandon their innovative hub motor system for a conventional front-wheel drive setup. This wasn't just an engineering decision. It was regulatory compliance driving fundamental design compromises. The unexpected consequence multiplied production delays. Every regulatory challenge created cascading effects throughout the development process, requiring redesigns, retesting, and recertification. The EV startup landscape of 2024-2025 became littered with failures. Fisker filed for bankruptcy, despite reaching production. Canoo collapsed after burning through investor funds. Lordstown Motors shut down. Nikola faced fraud charges. At least 30 EV companies suspended operations or faced bankruptcy in the past decade. What it lacked was the harsh reality check that automotive manufacturing has destroyed more fortunes than it's created. The barrier to entry appears low. Until you discover the capital requirements, regulatory complexity, and operational challenges that separate concepts from profitable companies. In reality, even well-funded startups with experienced management teams regularly failed. The business reason was simple math. Automotive manufacturing typically requires billions, not millions, to reach sustainable scale. Aptera's total fundraising of $190 million represented roughly one-tenth of what experts consider necessary for automotive startup success. The most obvious example was Lightyear, Aptera's closest competitor in solar EVs. Despite reaching production and delivering vehicles at €250,000 each, even they ultimately failed. If a company that actually delivered products couldn't survive, what did that mean for Aptera's prospects? The unexpected consequence for investors was sobering. The probability of total loss in EV startup investments had proven far higher than early projections suggested. Aptera's continuous need for capital created a vicious cycle for early investors. Each funding round typically occurred at lower valuations as the company's credibility diminished with each production delay. The mathematics of equity dilution meant that even if Aptera eventually succeeded, early investors might receive substantially less than their proportional ownership suggested. What it lacked was the ability to achieve milestones that justified higher valuations. In reality, companies that miss production targets repeatedly face investor skepticism that drives down pricing in subsequent funding rounds. Each delay signaled to new investors that previous timelines and projections were unreliable. The business reason was brutal but logical. Late-stage investors demanded better terms to compensate for increased risk as the company's cash position weakened and deadlines slipped. They insisted on conversion terms, liquidation preferences, and anti-dilution provisions that protected their investment at the expense of earlier shareholders. The most obvious example appeared in their SEC filings, which warned that future fundraising rounds could result in dilution, and that the company plans to raise significantly more capital. For existing investors, this wasn't just a warning. It was a mathematical certainty that their percentage ownership would shrink. The unexpected consequence created perverse incentives. Shareholders faced a choice: invest more money in subsequent rounds to maintain their ownership percentage, or accept dilution that might render their initial investment worthless, even if the company eventually succeeded. Despite its challenges, Aptera captured something powerful in the American imagination. The vehicle represented optimism about solar technology, efficiency innovation, and sustainable transportation. Sandy Munro's endorsement lent credibility that attracted engineering talent and investor attention. Over 750,000 community members joined their movement, creating a passionate fan base reminiscent of early Tesla enthusiasm. The company pushed boundaries in aerodynamics, achieving drag coefficients that impressed even skeptical automotive engineers. Their solar integration concepts influenced broader industry thinking about renewable energy in transportation. Major investors like Google's early participation validated the technical potential, even if execution proved challenging. For many investors, Aptera represented more than financial returns. It symbolized support for American innovation and environmental solutions. The reservation holders and shareholders formed a community united by shared values and hope for transformative technology. Whether Aptera represents the next Tesla or the next Fisker depends on whether revolutionary technology can overcome fundamental business execution. For investors, the question isn't whether the vision is compelling. It's whether vision alone justifies the risk of total loss.